legit. Anything you want.
My $1,400 by January 1st gold price forecast will probably need to be revised. Michael says his gold price forecast for New Year's Day may need to be revised. Here's why we may not make it to $1,400 come January by Ishal Balanger. Treatwise reports back in the 1960s, from time to time, many of my elementary school classmates would have great difficulty paying attention to the teacher. It would usually take the form of dawdling with a pencil, drawing prepubescent renditions of monsters or hot rods or animals. The polite term for such distraction was the inability to stay on task. The remedy for failing to show the appropriate focus on the teacher was either a scolding, b. ridicule, sometimes the worst if a particularly cute girl was present, or c. a sharp crack on the knuckles with a yardstick, because in the 1960s, classrooms commanded order where corporal punishment was not only accepted, it was promoted. Baby boomers, who love to reminisce about the old days, think fondly of elementary school and can readily recall which teacher was a nightmare with the strap or the yardstick or the back of his or her hand. I assure you that not one boomer ever suffered any sort of long-lasting trauma, either physical or psychological, over being punished for acting out in class. For that reason, bad behavior was rare in classes where Edwardian punishment was common, and there was no such thing as tension deficit hyperactivity disorder, because the antidote wasn't Ritalin or Adderall of Folklin. It was a non-chemical preventative called pain and or embarrassment. And there were no AFE places or support groups for the guilty party. So when I look at the last week of trading, I am forced to simply shake my head in disbelief and acknowledge the existence of some rare form of memory-sapping disease that has been spread like the Ebola virus around the trading desks of every firm on the street. It was only 10 days ago that the 2-and-20 world was coming to an end, but a bunch of XPOX junkies representing the first generation in history who prefer a telephone to a wide screen, theater sound room for personal entertainment, is now incapable of remembering exactly why they were soiling their undergarments during the final days of October. They're leveraging to the absolute max to make this rally a life-changing event, and you know what? They just might, albeit for the wrong reasons, get an oh-so-deleterious outcome. I was part of the security staff in 1975 when Led Zeppelin played the old St. Louis Arena, and I vividly recall the moments when the lights went down and a massive deluge of kids rushed the stage. We had set up a barrier line, but Zeppelin was so incredibly popular with stoners that we had to stand at the barrier actually watching these 90-pound hippies, so intent upon being inches from Robert Plant's blue jeans, and literally throw them back into the crowd. It's a defining moment in a young athlete's life when your high school rock and roll heroes are now at the mercy of a crowd of whacked-out teenagers and you are suddenly on the side of darkness as opposed to the forces of good. Well, after the brief but terrifying skirmish ended with the first chords of Jimmy Page's bone-rattling rendition of Heartbreaker, life returned to normal and the music plus the mass medication put the crowd back into LO mode, and back I went to the front of the stage, arms crossed and scowling fiercely so as to keep the zoned-out hipsters at bay. Today's market participants remind me of that crowd back in 1975, with Fed speeches and interventions taking the place of recreational medication and smuggled-in booze. Here is another comparison. In the 70s and 80s, it took months to turn sentiment. Today it takes a couple of well-planned Fed member orations and a few tweets from DJT to turn the prevailing sentiment from bearish to bullish, such that there is a new meaning to the word prevailing. How about leading sentiment or temporary sentiment or object to drug-induced paranoia sentiment? The current market environment is analogous to the final flailings of a beheaded chicken, furious, directionless movements until it collapses from its own lack of neural leadership. The kids manning the trading desks think that LL is well because the S&P reclaimed the 200 daily moving average DMA, while I contend that this very hungry bear knows he is going to be feasting on a great many unsuspecting millennial carcasses in the next few months. What better way to ensure a feeding pool than by encircling a larger population of prey through the installation of false confidence during these desperation-fueled rallies? On October 30th, I constructed a missive entitled "October's Rot Was Meaningless," posted a chart of the S&P 500 dating back to 2009 and submitted that the October correction was finished at the precise point where the October decline hit the 10-year trend line drawn off the March 2009 low. Sure enough, we are now up 200 S&P points and about 2,100 Dow points from the lows, as underperforming managed money implements its desperate ARB demon, buys up all of the momentum names in an effort to save years and bonuses from disaster. I have elected to raise cash into the rally and then try to determine whether there are enough animal spirits and irrational overexuberance to drive the indices back to the summer highs, which I think is entirely possible but by no means probable. As we all learned from our mentors, legendary traders have always confessed that the most money they made was never anticipated in top but rather exploited in top, once it was in. While I think that the double tops shown below are now cemented and in place, we are still a long way off the 2018 high of 2,940 for the S&P 500. The great challenge for me will be trying to short this garbage as close to the 50 DMA as possible without the chance of a whipsaw on a spike to 2,945 inches early January, as the final sputter of the tank empty engine resigns itself to a long winter's nap. Another thing that is annoying, verging upon maddening, is the inability of the precious metals PMs to break their bondage to the US dollar. We had 4 brief spikes in gold on October 2nd, 11th, 15th and the 23rd, and the last one on November 1st, but there is never any follow-through, and as such, the PMs remain range-bound, with $1,210-$1,220 as support and $1,235-$1,240 as resistance. Once again, Fed policy and member jawboning are contributing to the malaise in the metals, because the algobots have glommed onto the notion that interest rates are going to continue higher for the balance of the year. Since the rest of the world is dead set against the mere mention of the term quantitative tightening sounds like a cosmetic surgery of sorts, no? Fixed income investors are swarming in droves into the US 10-year Treasury at the recent 3.24% yield because it is sharply more generous than comparable Eurozone or Asian bonds of similar duration, and DTHEY get the bump in the currency. The problem with chasing the 10-year is that once the stock market reasserts its new primary trend to the downside, the negative asymmetrical yield effect of declining asset prices is going to start showing up in the economic numbers, resulting in a sudden and sharp policy reversal, that is, rates stop going up. When that happens, the yield advantage will be yanked out from under their feet and the ensuing currency crash will wipe out the DGE afforded by higher yields. As always, timing these policy reversals isn't just difficult. It is impossible. But if I am right in my strategy, all risk assets including stocks, base metals and gold-silver will have a violent upside reaction once the Fed blinks. DJT will leave Chairman Powell be for the moment because his beloved legacy benchmark, the stock market, is enjoying a wonderful relief rally and he feels rather cocky, so the widely anticipated December rate increase is probable, assuming this stock rally lengthens out to a year-end rally. It sets the target period for a possible policy shift as Q1/2019, so my forecast of a $1,400 gold price by New Year's Day is probably going to need to be revised. However, if the rally fails and, in fact, heads into another major down leg here in November, the odds of the policy reversal spike up in the risky assets may get an early jolt. The point is that once again, Fed policy and member blathering are the drivers, and as much as it makes me want to hurl my quote screen into lovely Lake Skagog, I am forced to simply deal with it. Trade accordingly and keep an eye on the uranium plays at $29.20 per pound. They might catch a bid very shortly, and when the U308 stocks catch fire, the returns are scary. The trigger will be $30 plus uranium, and that could happen next week.